Okay, hello everyone, and welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. As usual, we're going to start with our disclosures. I'm going to share a few things in the chat with you guys. We will be on Facebook again. We're starting to stream to Facebook. If anyone's on Facebook and has any issues, please let me know. Just sharing a few disclosures and other things right now in the chat. Hopefully they came through okay. Maybe they all bunched together. I'm going to add some line breaks to them and redo it in case they did. Sorry about that. So it's great to be with everyone. Market kind of pulling back to a weekly low from 2 weeks ago that we identified in our rundown. So remember, you can see that rundown. If you go to tradestation.com, click on Insights at the top of the page. Then you will see a blog, and on that blog, you'll see today's rundown. Let me just quickly take you there. All right. All right, so go to TradeStation, go to Insights. And on this blog, you will see an article right here. No Stag and not much Flation. That's the thing we're going to talk about today. But a few of the things here, we have an article covering some of the big themes in technology, the big tech stocks with earnings coming out relatively soon. We had an article recently and we pointed to what was happening with small caps and things like that. And now we're giving back some of those gains. And what we've just really seen is, a pretty interesting move to the upside, and at the same time, some enthusiasm and things getting ahead of itself. So I want to just quickly jump over here and show you a thing or two. We will start with my first. I'm going to actually start here with my MTES to show you something. So if you look here in our rundown, which I have right here, you can see we pointed out 55.77 and 55.62. 55.77 was the low of a bearish outside day we had not that long ago. Right here, you can see this is the cash index, SPX.X. We tried to hold this level right here. If you look on the hourly, it's right around 55.77. If we go and look at this on like a 15-minute candles, you can see that we tried to hold 55.77, and then we basically broke through it. And now kind of 55. 62 was another level we've been trying to kind of hold, and it's interesting to see how we're dancing on either side of that right here on the 15-minute chart. That is the low from last week, and so kind of watching that now. My perspective, one of the attributes of this market has been that it holds tight recent lows, and that's a sign of the fact there's not a lot of selling pressure. That was some of the patterns we had seen. If you look at the market, we look at S&P, for example, we talked about this pattern multiple times. This rally tight, rally tight, rally tight. However, we're not seeing that. It's not necessarily a sign that the market is anything bearish. It's a sign of, as a sort of rally progresses, you get more of pullback. So for example, if you look at the market back here in November, rally tight, then rally and a pullback to the 21-day exponential. And then as you see, as it goes up, you don't have as much of the tightness, but it has an uptrend. So what do we see now? We're pulling back to the 21-day exponential moving average, which has been an important spot. So I have this other workspace here that I'm going to show you very quickly. And now this shows new 52-week highs on the S&P. Now the way I achieved this was I set this to a 12-month of history, and then I said new highs for the chart as a show me, and I changed it to white crosses, and that allows you to see new 52-week highs. Now, some of the patterns we've watched are the fact that the 9-day rate of change stays, pretty much above zero or not far below it. That's one of the attributes of the market in this bullish pattern, and we have seen that. Let me just quickly, you can see that when we really got below this here, and we kind of, instead of bouncing at the 21-day, look back here at the beginning of April, we sat at the 21-day exponential instead of bouncing. The 9-day rate of change got negative and stayed kind of negative for like several candles, and then we got the washed out to the downside. So when you look at where the market is here, it looks potentially more like this than like this. And so the 21-day exponential here is going to be an important thing to think about, and also that 9-day rate of change. This RSI goes overbought. I call this when the RSI is cooking. It kind of just gets up there and it pushes, it gets overbought, but then it stays above 50. And that's what you saw back here. It didn't really, I mean, it went overbought, pulled back, stayed above 50 for a long time, and we're above 50 here. So I think this is kind of important to realize that when RSI goes overbought, it actually is a sign of overall strength. And so I think that's just an important thing to remember here. It's just that the market sentiment has gotten more bullish. We have seen the AAII sentiment survey go to the most bullish rating in a while. I kept it over here. It went to the most bullish since December 21st. So the the cat is out of the bag about this being a bull market. There is that wider sense now that things have happened that way. If you actually look, we had cited this last week, and it continued this week. So, for example, this article here that we did, our normal kind of rundown that comes out on Mondays, we had actually talked about this increasing bullishness. So basically here, this one here, the American Association of Individual Investors, it was high last week and it went higher this week. You can Google it yourself and find it. It's pretty easy to find, AAII sentiment index. But this is a sign also of more people are long and more likelihood they're taking profits. It's a contrary indicator. However, it can also go like the market can be irrational or overly bullish longer. Just because it is doesn't mean you're going to have a pullback. The market can be irrational longer than you can remain solvent or things like that. And I think it's important to realize that one of the attributes of a bull market is that it can get more giddy and more kind of optimistic than people think it should. They argue against it. They say this shouldn't be happening. It should go down. And then those sort of sentiments are what actually fuel the market to new highs, because those people remain on the sidelines. They refuse to kind of step in. And then what happens is they need to chase. So I think it's important here to realize that just because sentiment got overly bullish, there are some reasons for it. And we're going to be getting to those. Let me just kind of keep going through my notes here. So we look at our MT breadth workspace. Now, these workspaces are provided if you actually go back to the blog here and you go to the top, downloads available here. All of these are going to be available to you guys. So if you want to work with these, you can download the zip file. It has ELDs in it, which have custom indicators. And then once you have those installed in your TradeStation platform, you can then open up the custom workspaces we're working with. This is called MT Breadth. This shows various internals of the Russell 2000, the NASDAQ 100, and the S&P 500. What do we see? Well, we see that just yesterday we made the most new 52-week highs in a while, going back here to March. We see advanced decline line finally making new highs, and so we see these internals here on the SPY. We also see very strong internals on the Russell 100, as a lot of people have talked about, and we have this kind of breakout now to 52-week highs on the Russell. So this is interesting, and the one thing I will say is that the Russell has often been kind of a day late and a dollar short. It shows up last at the rally. And so I think we also have to be aware of the fact that, this could be something that has entered a new period of strength. However, that doesn't mean that, that it becomes a leader or something like that. I think it's just important to realize here that, the Russell itself has that strong kind of concentration in things like financials, and there's various aspects of that. And at the same time, the big bulk of the market is in things involving AI and the large cap sort of technology stock. So those remain really the workhorses of the market, and they remain under pressure and things like that. There's a spot where things like the Russell are not going to just keep going independent of those other names. So I want to just point out the breadth is wide. So right now, my main takeaway at the S&P here is, let's see if we hold the 21-day exponential. In my view, we're under this level. This was that weekly low here from July 8th. I always look at the weekly lows. It's not necessarily the most important thing. I mean, there's various levels through here you could look at, and I'm not really sure even at this point which levels to really be focused on. What is interesting is we're now setting up for a bearish outside week, because now this week we take this to a weekly. This is now a bearish outside week, and that is potentially a reversal pattern. Other times when we take out the low from the previous week, we see more of a push to the downside. It's not always the case, but I think it's going to be important to see how much further, to the downside here there could be actually selling pressure. Like I said, I'm watching right now the 21-day exponential moving average in the S&P 500. I'm watching the 9-day rate of change. Those are like my two kind of main things here to kind of see if the selling gets worse. All right, so just some near term sort of things. Let's take a look here at some of the things we actually see in terms of sector performance, and what we can see just in the last week or so is see this very strong outperformance in small caps and the Russell, strong outperformance in financials and industrials, and a strong underperformance in the growth areas. And I think that's something that we all know about in different ways, but just so you realize, this is um, MT main, the key ETFs, and it shows us that performance. And you can see here this kind of widening differential between, or at least this recent differential. What's nice about this workspace is you can look on a year to date and you can see, wow, clearly semiconductors, Nasdaq technology are leading, and things like small caps are not. But then you can look on the different time frames and see, wow, there's been a real shift recently. So I just kind of look here, really, I just eyeball it and I see, here's a big number on the 10-day performance, and here's a small number on the year to date. And then you can see here just the opposite for SMH. It's down in the last week, and then it's up like 45% year to date. This is a way to very quickly visualize and have a sense of where the performance is in the market. And I wanted to just kind of just remind people that that's one of the things we always kind of start with as we look at the high level of where the sectors are and things like that. Now, the one thing right now is a lot of this now has kind of happened. Yesterday, we had this kind of double whammy of Biden cracking down on semiconductors. Well, there was an article saying that he was going to increase restrictions on semiconductor um, trade with China, and then and then Trump comes out and says, like, Taiwan needs to pay for its own defense and stuff. And obviously Taiwan is, such an important area in the semiconductor realm. These are political things, and historically, these political sort of things become buying opportunities and things like that. I think the one thing to be aware of now with something like semiconductors is that they have run so much and people own them so much. And the other issue is that if we enter a period here of rate cutting and lower interest rates, there is a real potential argument and thesis in favor of value stocks and financials and things like that we have not seen. So there is risk of rotation, which has nothing to do with the politics. It has everything to do with the macro story. So I think that's just an important thing to kind of bear in mind. So that's what we see here from MT Main. I'm going to just quickly show you our standardized returns. You can just see that for some of these ETFs. Now, remember, we have also shared the link to the prospectuses of these ETFs if you're interested in those. So now, looking at some of the events coming up, speaking of Trump, he is speaking tonight at the Republican National Convention. And, we have seen something of this kind of, quote, Trump trade. And I think it's important to realize, though, that there's two arguments that, kind of, for a few arguments in favor of small caps, this idea of, the industrial thing, and if Trump encourages domestic manufacturing. I mean, who knows about that? I mean, some of this stuff Biden did encourage domestic manufacturing, but I do think one of the narratives is M&A. Um, you know, the, um, the the Federal Trade Commission has been relatively anti-merger under Lena Khan, and a Trump administration would probably replace her. And so there is a perception that a Trump administration would be more favorable for M&A, and that in turn would be more favorable potentially for small companies, small caps, things like biotech and things like that. Another thing that is emerging that I think is interesting is Intel. Intel is kind of emerging quietly, unusually, as a Trump stock. This is a company that is potentially if we're going to see a reshoring of American semiconductors and things like that, there is a perception here that Intel seems to be favored. It's interesting to see Intel, doing well relatively in the short term as the other semiconductors weaken. But again, this might also be a political thing where instead of this being a political pullback as a political rally, and it could be something where the result of this is an opportunity to get in on the bearish side. And I would think that a lot of Intel's issues, it's like Boeing; they're not going to be fixed super quickly. When you look at a lot of the history behind it and a lot of the momentum in terms of where the business is right now, so Intel might be kind of sneaking up toward a level where people might be thinking about some put spreads or things like that. Wanted to just kind of mention that there are two other potential political things that I see happening. And one thing I thought was interesting was that Trump was speaking about Ukraine in an article. I think it was in Bloomberg, and then we also had JD Vance's vice presidential pick being critical of aid to Ukraine. And at the same time, we see Germany cutting aid to Ukraine. So what's the point of all that? Well, my point is that a big thing that's been happening has been a shift globally of central banks toward gold. This idea of things like sanctions and stuff, pushing Russia and other countries away from using the dollar. And some of that has benefited gold. But the thing is, what happens if something happens in terms of the Ukraine conflict starting to end and resolve? I really have to ask what happens to gold in that scenario. And it might actually be a net negative on gold. So I think we have to realize here that one of the things that Trump might actually have an impact on could be negative for gold. So we've seen a lot of strength in gold for a while. And I think it's important to realize that a lot of those gains have to do with this idea of foreign central banks buying gold, and partially because of things like sanctions. So if something were to resolve in Ukraine and maybe the sanction situation eases and a lot of this, global sort of tensions that we've seen in the last few years, if those start to ease, that could be a problem for gold. And I think a lot of people have been kind of buying it thinking, oh, the gold trade is back or something like that. But, gold historically has not performed well in bull markets for equities. They historically diverge. So I just think it's important to kind of bear that in mind, that is a potential negative. One other that is a Ukraine stock, which not many people know about, but EPAM is some kind of tech stock. They have some kind of business link in Ukraine. And when the Ukraine war started, this stock got hit really hard. If you look back to back here when the Ukraine war started. And so anyway, EPAM, I don't know that much about it, but I know there's a link to Ukraine. If you read their business, they have some kind of involvement that's pretty significant with Ukraine. So this is another thing where this one might also be one of these kind of interesting under the radar names if we do start to see the something with Ukraine. I thought it was really interesting that Germany took those steps. I mean, this is not a webinar about geopolitics or anything like this, but we're getting near an election. There's people talking about stuff, and these things can have an impact. So I think that these are just real things we need to just remember. All right. The other thing that's happening globally was I thought very interesting. Chinese GDP was they came out over the weekend and it was up 4.7%, and it was lower than expected. And retail sales were lower than expected. China is, kind of struggling. It seems like at this big, Communist Party meeting, they haven't really done very much in terms of anything to stimulate the economy. And at the same time, what's interesting is that with their overall, economy just kind of sputtering. I mean, the thing with them is it's a lack of aggregate demand. And then what does that mean for global inflation? And China has exported deflation before. And the thing is, I think we could see that as well as a situation here where, um, there's obviously all these ideas about tariffs and everything like that, but simply by kind of squeezing China right now in various ways, that is pulling down copper prices. And I think that's the main thing I want to just kind of say here. Look at copper, and copper is a sort of indicator for China. And everyone thought copper was gonna like be in this big rally and blah blah blah. Again, copper is a it's an indicator for things like inflation and stuff like that. So you put all these things together, and there's things here that in some ways remain potentially more bullish for stocks as time moves forward. Lower inflation, things like China not driving inflation, all these forces. So I want to just point this out, that this is consistent with a potential sort of Goldilocks scenario overall. But at the same time, we have to realize that the situation, of the over concentration in large cap technology could remain, problematic for a while. And in my view, I think one of the most problematic things to me is that earnings season is often a period of of selling. It becomes a liquidity event. So what I see as a possibility is that this period of consolidation will actually continue, and rotation, it could continue basically, for a while. This earnings season, people might simply use those opportunities to be selling some of the large technology names and rotating into financials, industrials, and other stocks that are going to benefit from lower interest rates. So I think that's a big thing to be aware of. And I think that we have to realize is that the outperformance in these large techs, and a lot of people talk to this, but the outperformance in the mega caps has been historic, and it's been an aberration, so to speak. And also, when you think about it, the environment of lower interest rates does create some potential fundamental strength in financials and banks. So if you look here in our rundown, one of the things we do here is we do link to where did it go? This one. We do a link to this my article here on the Trump trade, but it was just kind of interesting. This guy at Truist, used to be SunTrust and BBT, I think, but it's a regional bank. This guy's is one of these, old grizzly old bankers, knows a bunch of stuff about the insides of the business, and he was very positive. If you go and check out his interview on CNBC recently, talking about net interest margins are going to improve, and we could have years, potentially quarters or years of improvement for banks overall. Now there is. Let me see if I can find it. I think if I go here to, what is it? It's debt to GDP, household debt to GDP from the Fed. This has been going down, obviously, since the financial crisis. And the thing is, if interest rates start to fall, look at how it's been stable really since 2019. This goes up potentially if interest rates come down and households start to borrow more and they get mortgages and they do cash out refis. All those things happen. Well, what happens to financials and banks when that happens? So I just want to point that out. When you look at things like the amount of home equity people have, the income they have, the overall health of American consumers, financially is pretty high. There's potential here of increasing financial intermediation, as it's called, increased lending. And I think that is a big story that's right now in front of us. And if you're a long-term investor, you say, wow, I've made a ton of money in names like Nvidia and Meta and Microsoft. And the question now is, I can potentially rotate to another big trade in the banks, an investment that could make sense for quarters. And I think we have to realize is that, it's not as explosive as AI was, but there is a potentially widespread story here in terms of financials and the growth ahead of them. And I think that it's interesting to see that, and we need to kind of just, recognize that is a kind of a thesis that's growing in the background. So let's not, overlook that. Now, one thing I think that's interesting is we saw some interesting earnings. We saw the guy from Goldman Sachs, Mr. Solomon. I can't remember his first name, but he's the CEO of Goldman. Made some real positive comments about capital markets. I want to point out this is one of the things that I always kind of try and do as it's my journalist background, but also just, it's kind of common sense. This is Moody's. Now, Moody's is a really boring stock that no one really trades, but they're kind of like Halliburton, is for oil companies. If you're Goldman Sachs, a company like Moody's is kind of like, your picks and shovels, so to speak. If people are going to issue more debt, Moody's is going to see that. If you can have increased capital market activity, all that stuff, Moody's is going to reflect. And they raised guidance back here at the beginning of May, and they had a really strong quarter. And I think it's interesting to see that, we saw it here in these stocks, and then you look at like Goldman and the other financials that have had strong earnings. So I think it's important to realize here is that this is a broad trend, and the thing about it is that this trend has actually been in place for a few months now. It's been taking shape. So I think that right now we need to recognize that what's happening in financials is potentially something kind of interesting. I want to actually quickly jump over here to what is it? SI, what is it? I'm sorry, SI. Want to find the financial sectors. This is a trading view, but the financial sector has broken out to new all-time highs. So this, it made this peak back in 2021. It has essentially here what you could see as a bullish ascending triangle, and there's a breakout to new highs. So again, the charts are showing it as well. I want to just kind of point this out, that this is a weekly chart I did here very quickly, but these patterns are playing out. All right, so I've covered most of those main quick points I wanted to hit on. Um, I also did a trading view idea I want to just quickly show you here. It was called, kind of mega cap. This is what, Trading View. It's an API partner we work with. And we publish ideas on there. And this is interesting because it kind of showed this pattern. You might want to check this out. You can also find this if you go to the blog and you go to the top and you click through here. You can see this one. But what's interesting is it seems like this has happened now like twice this year. I mean, I hate to always think the patterns are going to follow this closely because that's not always the way it works. But I think it's just interesting though. History rhymes. So let's look at this here. Explodes higher to an all-time higher in earnings. Keeps plowing higher on momentum. Has a bearish outside reversal. Staggers. Lower high. Falls. Same thing back here in May. Breakout to new highs. Keeps running. Bearish outside day. Kind of staggers. Makes that lower high. And now I think we have to just kind of realize it. What I would just say now for Nvidia, in many ways, I think about some of these stocks is it's not just about levels; it's about time. And I think July now. This is now going to be probably a red month for Nvidia. So maybe just the month plays out, and then we get to the beginning of August and people turn the page. So I think we just have to kind of realize is that this is now simply a period of time where when things run like this, even technicals themselves are not necessarily it's not just about price levels. It's simply a question of um, letting these kinds of forces play out. And I think I want to just emphasize that. I want to check out this article. Now, one of the things we did in this article is we looked at the comparison of the Russell 2000 against the NASDAQ. And we kind of saw here that this ratio had a pretty historic move. And so I'm going to now show you something using TradeStation. Now, I just built this really quickly, but here's what I did very quickly. I have the Russell 2000 up top, and I have the NASDAQ. This is the futures of the Russell and the futures of the NASDAQ. Now, I know it's ugly, but we don't want to look at these top ones. I want to point out we now have the spread as a difference and spread as a ratio. So this is our kind of thing that we're covering down here in using the platform. Spread indicators are available on chart analysis. They compare symbols included in the chart under the data menu. So if we look here, you can see under data, we have two symbols. We have the ampersand RTY, which is the continuous contract for the Russell, and we have the same thing for the NQ. So this is just going to essentially show the Russell and the NASDAQ 100. And then what we do is we have indicators. We went to studies, add study, and we added spread difference and spread ratio. And you can see if I go to studies, edit studies, I already have those on the chart. I made them a little bit thicker to see them better, and you can see them here. So when you're doing this analysis, here's just a little trick that might be kind of cool. We don't want to see these prices. One of the tricks you can do that people might kind of not remember is that, let me just get myself off the screen really quickly. But one of the things that people can do here is that you can hide the actual symbol you're looking at and only see the indicator. It's kind of crazy. But right now, the main symbol is the Russell. Well, we can just go up here to data and then go to edit symbol, and we can go to the Russell and double click on it. or hit customize, go to scaling, and then change the subgraph to hidden. Boom. Now it will disappear. And I can do the same thing here for the NQ. I can go here to customize. Now remember, we are customizing the symbol, not the indicator. So just so you realize, um, you can do things to the actual like stock that you're looking at, or you can do things for the indicator that studies it. But they're two different things. That they kind of look the same and they kind of feel the same. You know, when you're looking at them, one is they're similar. You can do the you know how thick the line is and all those things. But in this case, we're customizing the symbol because these are the symbols. And so I'm going to go to scaling. I'm going to go to subgraph hidden. Okay, now look what happens. Now all I'm seeing are the spreads. I can change it if I want to something like, monthly. And if you look at this on a long term, you can see that the Russell as a percentage of the Nasdaq has been really tumbling since more or less 2007, and it's now at a historic long-term low. So just one of these little things, you can do this with something like semiconductors against industrials or things like that to kind of visualize. It's a useful sort of thing to have in your toolkit for doing for making these kind of big sweeping statements about is it a rotation or is there over concentration. These are some of the things that we have right there in TradeStation you can quickly put together to visualize that kind of price action and data. So I want to just kind of share that with you. So just remember that if you want to mess, these things are indicators. The spread is an indicator, which means it does something with the symbol, but then the symbol itself is the under data. And these symbols have data 1, data 2, data 3 is the way they're actually recognized. So right here, data 1 is the Russell, data 2 is the NASDAQ. So the symbols have a data number associated with them. And then if we actually go and customize the indicator, and you look at this, you can see it accepts inputs, data 1 and data 2. You could also have like data 5, 6, 7, 8 or whatever, and then you can adjust which which ones the indicator is looking at, going to customize indicator and going to the input dialog. I'm not going to get into it, but our MT breadth workspace uses similar, customization, these different breadth workspace that we have here. All right, let's go back to our MT main. We'll see some of the other points that maybe we wanted to cover were kind of interesting. I thought that it was interesting. We call this no stag and no flation because I do think it's interesting that we're seeing now that, or not much flation, because the CPI was cool, and we're having suggestions that will continue in terms of lower inflation. And one of those things for me, like I said, it is the China thing, but it's also the fact that the housing market seems to have kind of turned a corner, and we're starting to see more inventory come online. And as things move into this, into the kind of summer selling season and everything else, there is that kind of potential of people just kind of cutting prices more to get deals done. So I want to just kind of mention that the inflation thing remains out there in the background that could remain a positive. But then if you look at some of the data recently, we see the retail sales higher than expected, housing starts, building permits, industrial production, all really good. We mentioned these these chip things. And one thing I just want to mention here is that there is a risk here that sometimes going into an election you have someone who's kind of like a punching bag, like the pharmaceutical industry or whatever. But this year it could be China, so we could see who wants to be. They're both going to basically take a hard line on China. So I think it's just something to realize here is that last week we talked about the potential for some kind of bounce with this Chinese meeting. It didn't happen. I think now we actually could be in a spot where we see further deterioration in sentiment toward China, maybe more downside in the Chinese stocks. So just realize, Trump and Biden could both beat up on China, and at the same time, their data is not looking great, like their GDP and everything. They failed to come up with any kind of good stimulus. This could actually be the time when we start to see more downside in Chinese equities. We mentioned this thing about the bankers being optimistic. And that was interesting. The Fed speakers were mostly kind of dovish. Most of these guys, Powell said more dovish things this week, along with Kugler and Waller. Kugler is a new person. Adriana Kugler on the board of governors. She's a new one. I think she just started this year. But they were all pretty much dovish. So now we're in that spot where the September rate cut is pretty much priced into the market. Um, Now, what I thought was interesting was that here's a little tidbit. General Motors basically one day they abandoned their goal of 1 million electric vehicles, and the next day they increased production of the Escalade V8. Then you look at Ford Motor, and today they came out with something when they are going to spend $3 billion to expand large truck production at a Canadian plant that was going to be making electric vehicles. So I think when you also look at like the presidential situation, all that stuff. Again, these things are kind of swinging away from green energy. So I think again, this is something else we just have to kind of be aware of. And this could be something where here we are in July. Well, into November, it could be kind of problematic for some of like the green energy things and that sort of. So you just realize this could be something when no one will want to be owning them, and they could have some kind of cascading selling pressure. So I think that's an important thing also to kind of bear in mind. Some of the big names in green energy are things like ENPH. Obviously, some of these are in downtrends, but I think when you look at these, um, you know, it has essentially moved sideways really for a while here. And will there be more risk earnings coming out on the 23rd? This is maybe interesting. So I want to just point out that there's not a lot right now. It's like things seem to be kind of the pendulum is swinging back away from kind of the green energy stocks and toward when you see GM and Ford both increasing, pickup truck production and things like that, it tells you that a tide has kind of turned here, and you have a stock like, something like Enphase that has basically gone sideways after a major sell-off, and you have to kind of wonder if there might be more sort of, weakness into kind of, with earnings coming and then kind of into year end. So this is something else one just kind of point out. Retail sales, like I said, this week were strong, which is an interesting sort of report when you realize that um, the labor market has softened, but all it's really done is gone back to where things were following, or before the disruption of COVID. We're kind of back now to normalcy after 4 years of craziness in the economy. Um, there's been a lot of noise and energy, and I'm not really sure what to make of that at this point in time. But a lot of the kind of people I follow have essentially been pointing to the fact that there is the potential for kind of excess inventory and relative weakness in demand. And that's another thing I think we need to kind of bear in mind is that the energy, look at like crude oil here. If you look at it, you know, I think it's in this kind of tight range here, but you do have this kind of downtrend line that I'm kind of watching this to see if something comes together. I think there's an OPEC meeting coming up I didn't get it on my calendar yet. I think it's the beginning of August. So let's just kind of think about that, especially with, weakness in China and things like that, or a resolution to the situation. I mean, I'm not saying something like that with like Ukraine is going to happen anytime soon, but like, if the global situation actually doesn't get worse, if all this negativity out there actually kind of goes the other way, and you have the OPEC thing coming up and not the greatest demand and weak Chinese demand. You put all those things together. You look at oil here making these sets of lower highs. I think there's something else just kind of to think about. Weakness in copper. These things are all kind of barking up the same tree potentially. So the other article I thought was kind of interesting. More teens are working. Is an article on CNBC, but again, it's also kind of a situation to show that the labor market is kind of bringing people in and seeing some even like teens go to work. A lot of the job growth in the labor market has been for less skilled labor. Well, something like teens coming in could be another thing that's kind of deflationary essentially. And I think that's an interesting point. Other thing that was interesting was the Federal Reserve had its beige book. And what was interesting here was they said, if you look at this article, they said districts reported a level of increase. All right, 7 districts reported increase of activity. 5 noted flat or declining activity. three more than in the previous report. So this beige book comes out. So what they're basically saying is, they report by districts. There's a different Fed like Richmond and Cleveland and St. Louis, and all those feds have their own districts, and they report by district. What they basically said was that there's now five that are essentially flat or negative, and before it was only two. So basically, widening weakness. Again, if you're Jerome Powell and you're thinking about cutting rates, this is what you want to see. And so I want to just kind of point this out. This is consistent with more of a dovish policy. All right. Trying to see what the S&P is. Yeah, S&P now is just kind of we're just in this kind of dead spot here. I think when you look at the calendar, there's nothing really. Now that we're under that level that I'd kind of mapped out, we're looking at a bearish outside week, and I think we just have to realize that we have a dead spot in time. Really, we have some time before earnings really hit. Let me just quickly show you how to see that with TradeStation's platform. Go over here to our earnings dates, and let's just bring in real quickly the NASDAQ 100. We can see when the upcoming earnings are. We also have them mapped out here in this in our earnings story right here. Big tech earnings coming soon. All right, let me what are the other things I wanted to cover? To cover the Chinese weakness. Now, there are people who basically have been making calls about there being a potential kind of sell-off or significant pullback sometime in July. Goldman Sachs was saying there was going to be a pullback right around this time, and they said, don't buy the dip, which is interesting. Goldman Sachs said that yesterday. Bank of America, Subramanian Savita, I think is her name, was saying that a 5 to 10% pullback is possible, all those sort of things. So just kind of people have been making these calls, and we are in a kind of dead spot here for news. So I think that, like I said, I'm watching that 21-day exponential moving average, and aside from that, I'm not sure on other levels. I'm waiting to just kind of see this sort of do we get you know um, a real breakdown through those levels. And at this point, I think historically, um, it would be a question of does it just knife down through all that positive momentum? And historically, that sort of has not really been the patterns. And I think that the 21-day exponential moving average here remains the key thing to be watching on the S&P. Let's actually take a look back over at that. Just basically touching it right now. So it's at 34, and today's low is the low. It's pretty close to it. Our low, we basically got within 2 or 3 points of it. So um, that is going to be the thing to watch anyway. I'm just kind of looking through some of the other points I wanted to cover before we dig in to see if there's any other interesting things popping up on the platform. Those are the main news articles I wanted to cover. But essentially here, the market runs expecting things. The market has run in expectation of lower rates in a sort of dovish, environment. And those things now are, essentially kind of priced in. And now as the news comes through to confirm it, people kind of sell the news. This is one of the normal things you kind of, expect to see. So now if we look here at the MT main, the earnings tab, earnings dates, you can kind of sort here to see when the big earnings are coming up. Now this is set up so that you can highlight the companies that trade a lot of options. I like to just kind of highlight these. I show this to people a lot, but it allows you to kind of map out and look into the future and see the names that trade a lot of options like Tesla suddenly light up really bright for you. And it allows you to kind of just kind of go down and plan some of the upcoming events. So this is something that that is included in the workspace that we share with everyone. So those are the main things I wanted to cover immediately here. Um, and now I'm going to just jump over and kind of dig through the platform and see if we have any questions. All right. So let's start off, like I said, with our key. Well, we showed the key ETFs. Let's now go to our price grid and let's bring in the S&P 500. And we're going to also go to MA Tools and bring in the S&P 500. There really is. If we look at also look at the calendar next week. I mean, in many ways, we have a dead spot of news until GDP next week. So just so you realize that GDP is a week from now, and we have some earnings. It's a lot of like financials and stuff like American Express and then General Motors next week. But we're in kind of a dead spot here. So just kind of realize that. I will add that I've had a lingering suspicion that we need to have a digestive period like we saw last May or May of 2023. If you look back here, this moment here was to me a fascinating period. And basically, we rallied. We had the crash on the regional banks blowing up, and then we had the rally on AI, and we moved sideways, and we were worried about the debt ceiling. And then when the debt ceiling was raised, things started taking off. So it's interesting to me here is I have thought that we might see a period like this as we approach the potential, Fed rate cut, or in this case, it could be the Fed meeting at the end of this month when maybe they will give some kind of clear confirmation or something like that. But I want to just kind of point out that this period was kind of illustrative to me, and I want to see if maybe this is something that we settle into. Like for example, if we need to see this rotation away from big tech and things like that, we could have a period of an extended sideways move, for a couple of months as we kind of consolidate. So I wanted to just kind of point that out. This is something that it might not be a big pullback. It could be a sideways move during which time things like financials and industrials do well, and there's just a lot of churning in the large technology stocks. All right, now let's take a look here. Actually, I'll briefly go back. Actually, one other thing I want to show you. MTES. Last time we did the webinar, we basically it was right here last Thursday, the 11th, and we had talked about how this was something of a potential buy signal. The fact that stochastics were oversold, given the uptrend, and it did bounce from there, and it worked. Now, when we look at there's really nothing here that gives us any kind of signal. I mean, if anything, the signal here was, it happened at 3 o'clock in the morning, but there was a bearish sell signal right up here because basically the 50-hour was falling, as you can see by the 50-hour. This only works on the futures, the hourly moving average. This is the moving average speed. So remember on this chart, we're looking for there's three signals, and we look for two of them pointing one way or the other. The stochastic MACD and the speed of the 50-hour moving average. So in this case, the 50-hour moving average was falling, which is this histogram here, and stochastics was overbought. That was two out of the three. Therefore, that was a potential sell signal. As we look at it now, stochastics are oversold, MACD is falling, and the moving average is falling. So this is giving us still a bearish signal here on the short-term sort of chart. So there's nothing here that really tells us much opportunity yet. However, at the same time, this is something that is really more tactical. So at this point in time, I mean, something like this could be um, uh, something that simply turns into a period of neutrality. Then you get a rally back and then more of a push to the downside. Or if it stabilizes, you would see it essentially move sideways. The moving average would come down. They would kind of come together, and then the moving average could start grinding higher, and then it could turn back into a buy signal. So I was just pointing out that this is not right now, in my view, giving us any signals. It did give a signal at 3 o'clock this morning, and it did give a signal in our last webinar, as we had mentioned at the time. But this is another one of these tools to kind of look at, which is interesting for the S&P. It uses the S&P futures with these indicators on the hourly chart, and then it has the cash index just for fun. Well, not just for fun, but just to be able to see levels and stuff, and to be able to compare. This is hourly, but you can change it as well. I'll also mention that I did a little bit of history, and this hourly surge is one of the longest hourly uptrends in the history of the S&P. I mean, from what I could tell, I went back and did some historical analysis. This consecutive streak of so many hours up was like it was the longest I think since like the beginning of the century. I don't know exactly, but this was historic. I doesn't know if it really means anything, but it was just interesting to see that this was a pretty unusual move. But now I think it can highlight here that you now are kind of getting back to this level, these kind of levels where you might be looking at people might be wondering, are we going to go back and try and hold these old highs? Um, but I think right now the thing we have to really remember is we have a bearish outside week taking shape and a big gap of time, and it could just be some volatility and some chopping, and very short term price movements could be dominant at this moment. All right, as we kind of look over here at our price grid, we can see a few things here. Like for example, this will tell us stocks that have recently hit new highs. So for one way to see companies hit new highs today is to click on distance from 52-week high and look for a company with a positive number. So DR Horton had a good earnings report and a buyback. They jumped. But this, these will tell you stocks are hitting highs today. Another thing to potentially do is look for stocks that have hit highs in the last 10 to 15, sessions. So you basically go to days and 52-week high and low, and so this only recognizes new high after the day is closed. So it will not show companies hitting new highs today. But you can just go and like draw a line across it. I want to see companies that hit new highs in the last 15 days or whatever you want. Break it off with a label row and then go back up and sort by something like 5 day. And then you can find these stocks that were hitting new highs and have now pulled back. I mean, look at like Eli Lilly. A lot of these are names that are now kind of knifing down and probably, might be kind of problematic. So this indicator in and of itself is not um, a sure way. But the thing is, from my view, what people might want to be thinking about is remember that move in something like a Goldman. So Goldman had essentially kind of recently broken out to a new high. This is what we're looking for. We're looking for potentially stocks that hit a new high 3 to 4 or 5 days later. They're down 3 to 5%, and those are potential continuation trades. So this technique will find stocks that have been going straight up and are now knifing down, but it will also find stocks that recently broke out that might have continuation. And that's kind of what this little technique I'm just showing you is looking to do. So you might want to kind of look at that. It also, it's interesting to look here. One of the ones that jumped out is ELV, which is it's an obscure healthcare stock. But what I thought was interesting was UNH, United Healthcare, member of the Dow, had a strong earnings report, and there's been a lot of negativity in the health insurers. Now I know that they're very boring, but names like UNH and some of these, they could have had something of a turn, and I think it's important to kind of maybe just recognize that the healthcare index is also trying to break out now. And if we see a rotation away from big tech, in my view, if you are thinking about, if you're a large investor and you're thinking about what areas are going to do well with something like, money moving away from large cap technology, financials and healthcare are two areas that are just kind of sitting out there that are near highs that have not performed. And they are the kind of areas where, large institutional investors could be looking to put money to work. So I think right now what we're seeing in United Healthcare is a very interesting sort of move, and it's something I think is just it was very interesting to me. They've had a lot of weird negative forces because people were getting more healthcare, and then that was driving up their costs. But at a certain point in time, they have ways to fix those things, and I think it's important now is that some of these names like United Healthcare, especially, these are long-term growth stocks, and if you look at them, um, you know, there it is hitting a new all-time high. It's had basically a 2-year sideways move. This could be a name also that is like no one talks about. You can read whatever you want, watch CNBC all day, whatever, any chat room. I doubt many people are talking about names like United Healthcare, but it's a blue chip Dow member, major stock, and basically breaking out to new highs after earnings, after a long period of weakness. So I think that's kind of something that might be some of these opportunities that could emerge. There have been some interesting healthcare names, even with healthcare underperforming for a while now. There have been healthcare names that have done well, like Lilly. Before that, we had things like Cardinal Healthcare and McKesson that we had talked about on this webinar. And United Healthcare is one that I've been watching. And now we might be getting the breakout. But anyway, so that's one way to approach it. Keltner pullback is an indicator that will tell us when stocks are near the bottom of the Keltner channel. So you'll notice that Lam Research and these big tech names, AMAT, CrowdStrike, they're getting crushed. These are under the Keltner channel, which probably that can suggest that the selling has gone from it's not a modest pullback, it's carnage, and it's kind of like a deeper sort of period of weakness, and the trend is not necessarily going to be what you're looking for on the long side. However, you can kind of screen some of those out by using Keltner pullback. So remember, right now we're only looking at stocks that made a new 52-week high in the last 15 sessions because we put in the label row. So we already drew a line across, and we knew that we know the stocks we're now seeing are stocks that have recently hit new highs. So if we look for Keltner pullback roughly 0, we're going to find something different. You'll notice all these names that are most sold off are the mega caps or the large growth names: Lam Research, Crowd, AMAT, Lilly, Intuitive Surgical. Those are in there as well. But you have Microsoft, Meta, Clack, ANET. So these are your big, your big growth names. But then you get down here, and we have a name like interesting NetTap. This company has been quietly performing, and what you're seeing here is the pullback is more modest. And where is it? It's right at the bottom of that Keltner channel. So using Keltner pullback can help us find names that have pulled back but have not gotten like trashed. And so there's another sort of thing that's built in the radar screen. There's one of the custom indicators that we share with you guys in the workspace. It's just it's a way of taking something from the chart, customizing it with easy language, making it a little bit easier to use because we take out the stuff you don't need, and we basically make it a custom indicator that you can just use, and it's available to you guys in the zip file that we gave. So this is one of the things people might want to be thinking. Oops, sorry, my computer somehow being weird. I apologize. I put that back where it belongs. The key thing I think is looking for stocks that have made new highs that are pulling back modestly. So for example, Goldman, let's actually see how far down the Keltner channel Goldman has gone. See, Goldman is still even above its Keltner channel. So that might be just one that that's just, it's kind of interesting to see that it hasn't even gone back inside its Keltner channel. Anyway, I want to just point that out. Looking for things that are kind of a positive on the Keltner pullback. 0 means it's at the bottom of the Keltner channel. So there's a way that Radar Screen can help you find stuff on the chart. The other one is MA Tools. MA Tools will basically tell us stocks that have done things like pulled back to a rising 21-day exponential moving average or 8-day exponential moving average. So let's look at some of these. Also, we have average options volume here, so you can see the names that are more active. Now, Corning was actually a company recently that kind of broke out on the whole AI thing. Now, it's interesting here to see. Here it is touching its 8-day exponential. Not necessarily maybe as much of a pullback as some people might like, but if it pulls back to its 21-day, it will light up in this column. So if we look here, we're now looking at stocks that are pulling back to their rising 8-day exponential moving average. We can see AutoZone, for example. Not a super active name, but it's also just telling you this is a name that is pulling back to its rising, which means that it's had a short-term move to the upside. Interesting here that we also see Goldman. Like I had mentioned, Goldman right here is at that 8-day exponential moving average, which is the blue line on this chart. So another technique here in this sort of market pulling back could be looking for companies that are pulling back to a rising moving average, the 8-day, 21-day exponential. Of course, you can customize these things by going in here and right-clicking on the indicators. MA Test does simple moving averages. I have it set to 50-day just to kind of, you can see it. People talk about I don't find the 50-day as useful as it used to be, but it's here for illustrative purposes. You can right click on this, go to studies, edit it, and change what moving average you're looking at. Another thing we have here is our moving average order. So this will tell you that here's stocks where the fast moving average is above or below the slow moving average. Let me hide myself again from my screen so you can just kind of see here. This allows you to see stocks that have an upward trend, potentially with a 50-day above the 200-day. So for example, look here at, like, Alphabet, we basically have a stock that has a 50-day above the 200-day, and it's pulled back to the 50-day. Now the earnings are relatively soon on this, so a name like this, could just kind of sit and then explode one way or the other on earnings. But it's just, these are some of the techniques that people might want to be using as we get a pullback like this in the overall market. These indicators can help you find things that are in directional trends that have short counter trend moves. So these are some of those techniques you guys can use. All right. Well, it's great to talk to everyone. We will be back next week at this time, and I will see you again every Thursday at 2 p.m. Eastern. We do these webinars that kind of go through and show the ability of TradeStation to help people analyze the market, see some of the trends in the market, and potentially act on them. Hope everyone has a great day, and I'll see you next week. Thank you.